Welcome, students, to another class for the week. And we'll be drawing the curtain for partnership accounts in a halfway. Why I said halfway is because there are still many other things attached to this topic. It's a very wide one and very, very interesting. And today, these are the items we have to achieve. Appropriation account. Now, under the partnership account, appropriation account is one evident concept that you cannot do without. Reason is because appropriation account is the only account that differentiates between partnership account and sole proprietorship account. You have been taught final account over the time. The same concept of final account you were taught was meant for the sole proprietorship account one-man business account. So, but now what makes the partnership account different from that concept is the appropriation account. You were told this in our previous lessons, that appropriation account is the only concept that makes the difference between partnership account and the normal final account that you know. We start from the trading profit and loss straight also to the balance sheet. But here, after your trading and profit and loss account, you are meant to prepare your appropriation account, which leads you straight now to the balance sheet. Many more you are going to learn today. This is an illustration for us. David, Rex, and Phillips are in partnership. They share profit and loss in the ratio 5, 3, and 2, respectively. The partnership agreement contains the following. Number 1. The partners' capital are David 40,000 naira, Rex 15,000 naira, and Phillips 25,000 naira. So these are their contributions to the business. Rex, we are given that Rex will receive a salary of 6,000 naira, and you can imagine the effect of that salary under our current account, which you were introduced to in our previous lessons. Interest on capital to be 5%, likewise interest on drawings to be 10%. We also discussed about interest on capital and that of drawings in our previous lesson too. Now, in the year to 31st December 1992, the net profit was 30,000 naira. That is the net profit. Remember, under our normal final account preparation, after you have accounted for your trading account, then you go straight to your profit and loss, where you charge your expenses also with the gross profit. Your gross profit would have been gotten under your trading account. Now, when you charge your expenses against your gross profit, that gives us your net profit. Remember, it is this same net profit that we are taking into the appropriation account. So the net profit was 30,000 naira. But this is to let you know that this net profit does not mean the total profit for the whole partners. No, there are some other things attached. As long as we have drawings attached to it, and there is any of the partners who is under who is under salary collection, therefore this cannot be the final profit given to the members. All these things involved must be charged against the net profit, which is 30,000 naira, before we can now see the total profit that we are expecting to be shared among the members. Now, the partners' drawings were as follows. Okay, that means drawings took place during the financial period. David withdrew 7,000 naira at some point in time. Rex withdrew 5,000 naira for personal use also, and likewise Philip also withdrew 3,000 naira. You are required to prepare the appropriation account and current account for the year ended 31st December 1992. Now, this is another additional information for us to see. The current account shows the following balances. That means that is the balance brought probably from the previous year to the present year that we are about to treat now. That means maybe from 1991 coming to 1992. These are the balances brought up. So it will be a balance brought forward under our current account. And these are the balances. Now, David is having a credit balance, Rex having a debit balance, Philip having a credit balance. Here we go. Under our appropriation account, this will remind you what we did in our previous lessons again. Now, remember, the net profit, we are starting from the credit side. The net profit of 30,000 naira, remember, will be brought here. That is it. That's the net profit. 30,000 naira. Then, having done that, now, what are the interest on drawings? The interest on drawings, remember, we were told to calculate interest on drawings should be 10% of the interest of the drawings made. These are the drawings. Remember, 7,000, 5,000, and 3,000 respectively. So 10,000 naira on 7,000, 10% rather of 7,000 naira giving us 700. That means for David will be paying the business 700 naira for the 7,000 naira drawn by him. Likewise, Rex, the same thing, and likewise, Philip. The addition of all this comes here. And remember, everything you have here is in form of money coming into the business as the profit for the partners. While the ones here are talking about, that is the debit side is talking about money that will be going out of the business. Now let's take a look at the salary. Remember, the partners are paying Ayo salary. So, they are paying Rex. They are paying Rex salary of 6,000 naira. Can you still remember that Rex to receive salary of 6,000 naira? So Rex will be receiving 6,000 naira. So that means the money is going out. So that's why it's recorded under the debit side of the appropriation account. And the interest on capital, that is every money you put into the business, there's an interest attached to the capital introduced by every of the partners. Therefore, this interest will be charged, and it is the business, it is the company that will be paying each partner based on their capital involved into the business. This particular interest, 5% of 40,000 naira capital introduced by David, we earn in 2,000 naira interest. Likewise, that of Rex, 5% of 15,000, Philip, 5% of 25,000 naira. The addition of all this gives us 4,000 naira. That means these two will be charged. These two balances will be paid by the business out, while all these are being expected to come into the business. Now, at this point, I will let you know that the difference between the addition of this and the addition of this will now let us know, are we still having the same net profit or not? So, because we are charging all this against the income. So, and if that is the case, the addition of this and this will give us 31,500, while the addition of this and this will give us 10,000 naira. Now, that shows that the credit side is greater than the debit side. And if that is the case, that means we are still having money at hand to be shared among the partners. But should in case, if the debit side is greater than the credit side, that means that the business has run into a loss. Therefore, as it has entered into the debit side here, it will rather come here as share of loss. It will be here as share of loss. Share of loss. But in this case, there is no loss. They have all made profit after we have charged all these expenses against the net profit. So how do we now share it? So if we now take away this one, if we take away the addition of this from this, the remaining balance will be this 21,500 naira. So this 21,500 naira now will be shared among the partners. So which means the share of profit now, meaning how will they share the profit? We have been made to understand here that profit will be shared with a particular ratio given to them. Therefore, if we now look at it, for David, there is a percentage given which goes to David, Rex, this, then Phillips, this. The addition of all this will give us this. So therefore, we are having 31,000 naira balances for our appropriation account. So as that goes, now how will our communal current account look like? Now, the communal current account is talking about the same current account we have been dealing with. So don't be confused with the adjective columnar, because it is in column. That's why they call it columnar current account. So the current account, this is how it will appear. Remember, we were told that the balance brought forward. The balance brought forward here, the one we were introduced to here, David and Phillips are having credit balances, while Rex is having debit balances. That is what we can see here. Rex is having 200 debit balance, while David and Phillips are having these balances. Now, look at it now. Salary paid to Rex. This is it. Now, interest on capital. This is the interest which has been charged. You have been taught how to calculate the interest, and the percentage has been given to us. Here, the percentage has been given to us here. So, that is it. So, we have used that to calculate all their interest. Likewise, coming down here, drawings made by them, by each of them. This is it. It has come to the debit side. Then interest on the drawings charged enters into that bill, which has also been previously calculated. Now, the difference between the credit side, that is, taking a look at it from this end, taking a look at it from this end, from here also to this place. Now, that shows that the addition, because they have also shared their profit based on what we had here. The profit here, shared to them. That's it. Now, the addition of all this will be compared to the addition of all this to this end. To this end. Now, if we now subtract 100 this from 3,300, that's for Philip, it will give us 2,350. Then, the addition of this also, the addition of these three for Rex will be charged against what Rex has here. So it gives us 7,500. Likewise for David, 10,000, 2,000, 10,500, charged against 7,000 this. The difference gives us this. So they are all having debit balances. In that case, so adding them together gives us these equal balances here. Now, we round it up also with this second illustration. Now, this second illustration is drawing our attention to if there is no agreement. I repeat, if there is no agreement in the book, in the rule that is guiding the business. Therefore, how will the operation of account look like? This is how it will look like. There will be no salary. Remember, there was salary here, there was salary here. But here, because there is nothing like agreement, there will be no salary. Other things that you can see here will not be there. You will only have your net profit brought down. Other things will not be attached because there is nothing more attached if there is no agreement. This is how it will look like. Lastly, this is how the current account will also look like. If, I repeat, there is no agreement between, or that is the agreement that has formed the business among them. Now, this is where we're going to draw the curtain for today, and I'll be looking forward to your questions on the platform. Thank you, and God bless you all.